Covered calls are options sold on owned investments to generate current income. Here we'll review the best covered call ETFs. Covered call ETFs own stocks, typically from some underlying index, and sell call options on them to generate income. The call option is considered covered because the underlying security is already owned. Here are the 7 best covered call ETFs that are the most popular, in no particular order. First is QYLD or QYLD, the Global X NASDAQ 100 covered call ETF. QYLD is the most popular covered call ETF with nearly $7 billion in assets. QYLD launched in late 2013. Its popularity has soared in recent years with choppy, faltering markets, high inflation, and low interest rates during which investors scrambled for yield. There's even an entire community on Reddit dedicated to this single fund. QYLD is one of 3 covered call ETFs from Global X. We'll go over the other 2 shortly. As the name suggests, QYLD from Global X owns stocks from the NASDAQ 100 index and writes covered calls on them. QYLD has a distribution yield of 13.27% and an expense ratio of 0.60%. I did a separate comprehensive video on QYLD here. Next up is XYLD or XYLD, the Global X S&P 500 covered call ETF. While QYLD uses the NASDAQ 100, Global X also offers XYLD, which uses the famous S&P 500, comprised of the 500 largest publicly traded companies in the United States. This makes XYLD more diversified than QYLD. The retiree withdrawing regularly and using covered calls as income may want that greater diversification because it means lower volatility. XYLD is next in popularity with a little over $2 billion in assets. The fund launched in 2013. XYLD has a distribution yield of 13.13% and a fee of 0.60%. Rounding out this list from Global X is RYLD or RYLD, the Global X Russell 2000 covered call ETF. RYLD finishes the Global X covered call ETF trifecta and uses the Russell 2000, which is roughly 2,000 small and mid-cap stocks from the investable US stock market. That is, whereas XYLD is using large caps via the S&P 500, RYLD covers the rest of the US market with smaller stocks. As such, investors may want to combine XYLD and RYLD for greater diversification to capture the entire US stock market. RYLD launched later than its peers in 2019 and has about $1.4 billion in assets. RYLD has a distribution yield of 13.20% and an expense ratio of 0.60%. Next up is DIVO or DIVO, the Amplify CWP Enhanced Dividend Income ETF. DIVO is an income-focused covered call ETF from Amplify that launched in late 2016 and has roughly $2.6 billion in assets. DIVO aims to provide income from both dividends themselves and option premiums. To do so, the fund's managers actively select a handful of dividend stocks from the S&P 500. Selection criteria are basically dividend growth and strong earnings, and tactically write short-term covered calls on some of them. In doing so, DIVO leaves more upside potential but has a lower distribution yield than other funds on this list. This has worked out well historically with a greater total return than its broader counterpart XYLD since inception. But DIVO is also much less diversified with only 25 holdings. We also know active management tends to underperform passive indexing over 10+ year periods. DIVO has a distribution yield of 4.80% and a fee of 0.55%. Next up is JEPI or JEPI, the JPMorgan Equity Premium Income ETF. JEPI is a comparatively newer ETF from JPMorgan that launched in mid-2020 and has quickly amassed nearly $19 billion in assets. Earlier I said QYLD is the most popular covered call ETF. This is because technically JEPI is not really a true covered call ETF. It uses equity-linked notes or ELNs that basically have covered call mechanics baked in. These ELNs introduce a layer of credit risk for investors. JEPI is somewhat similar to DIVO in that it is actively selecting stocks from the S&P 500, this time based on value like price to earnings ratio, low volatility, and ESG, resulting in a basket of a little over 100 holdings. JEPI has a distribution yield of 11.66% and a fee of 0.35%, making it the most affordable fund on this list. Next up is KNG, the First Trust Cboe Vest S&P 500 Dividend Aristocrats Target Income ETF. KNG or King is a covered call ETF from First Trust that launched in early 2018 and has a little over $500 million in assets. KNG holds a famous group of stocks called the Dividend Aristocrats, US stocks that have increased their dividend over the past 25 consecutive years, and equally weights them and then overlays a limited covered call strategy on them to generate income. I say limited because the fund simply aims for a yield about 3% above that of the S&P 500. KNG has 67 holdings, a distribution yield of 4.07%, and a fee of 0.75%, making it the most expensive fund on this list. Last on our list is PBP, the Invesco S&P 500 Buy Right ETF. PBP is an older covered call ETF from Invesco that launched in 2006 7 and has about $100 million in assets. If you don't care about yield per se, but like the characteristics of a covered call strategy, PBP may be the fund for you because it simply reinvests all the dividends and option premiums from its holdings, giving it a relatively low yield of only 1.30%. Those holdings are just the straight S&P 500 via the same index as XYLD. As such, with a fee of 0.49%, you could think of PBP as basically a cheaper version of XYLD that reinvests dividends and option premiums instead of distributing them. Their total return performance has been nearly identical historically. I think PBP never attracted assets because it launched right before the global financial crisis of 2008 and then looked terrible during the market's recovery, as covered calls cap upside potential. Since some of these covered call ETFs have substantially different methodologies, you're probably most interested in a performance comparison among them. Since JEPI launched in mid-2020, we can't go back too far if we include it, so first we'll look at a short backtest that includes it, and then another one without it to look back a bit further. Here are the risk and total return metrics for QYLD, XYLD, RYLD, DIVO, JEPI, KNG, the S&P 500, and a traditional 60-40 portfolio for the period June 2020 through 2022. Because we're looking at total return, we can exclude PBP because its total return is virtually identical to XYLD. Also note this is the precise time period of an environment in which we'd expect covered call funds to beat the market, a gradual bear market. Also note that large cap growth stocks suffered greatly over precisely this time period, illustrated by QYLD's abysmal performance. Small stocks also beat large stocks over this time period, which explains RYLD's outperformance of both XYLD and QYLD. DIVO's tactical strategy seems to have paid off over the backtested period, even with just a handful of stocks. When we stop to think, this makes perfect sense as value crushed growth in 2021 and 2022, and DIVO is specifically selecting value stocks. Now let's remove JEPI and RYLD to go back a bit further to April 2018, which is when KNG launched. DIVO also performed comparatively best over this time period on both a general and risk-adjusted basis. Does that make it the best covered call ETF? Impossible to say. 25 holdings makes me nervous, regardless of what these numbers say. Unfortunately, covered call ETFs are probably not a great investment for most investors and are almost certainly suboptimal for young accumulators, even those looking for income. I explain why in detail in this video here. Do you own any of these covered call funds? Let me know in the comments. Thanks for watching.